If you want to know what a share is, and probably now more importantly, what this donut has to do with buying shares, stick around to find out. So what does this donut have to do with buying shares? Well, unless we're talking about the Krispy Kreme business, absolutely nothing. However, that being said, it does serve as a really nice analogy for today's video. So let's talk about this beautiful glazed donut for a second. Let's park shares for publicly listed companies and focus purely on this donut. So here we are, I've got this whole glazed donut. Yum. However, my friend Vincent has just arrived, and Vincent absolutely loves donuts. Say hello, Vincent. And I was always taught as a kid growing up to share, so I'm going to cut this donut in half so Vincent can have half and I can have half. So I've got a really important question for you now. Is taking a bite out of this half of the donut or this half of the donut going to taste any different to if you took a bite out of the original donut as a whole? This is a really important point to understand, so make sure you stick around to the end of the video to hear why this is so important if you want to be successful investing in the stock market. So what are the chances? My friends Marcellus and Jules have just arrived as well, so now we're going to need to go and cut the donut so there's 4 equal pieces so everybody can have a piece of the donut. So now we'll cut the donut into 4 equal pieces. Now let me ask the question again. If you were to take a bite out of any one of these 4 pieces of donut, would it taste any different to if you had have taken a bite out of the original donut as a whole before we divided it? Now let's take this a step further. Let's say that I paid $4 for this donut and my friends all wanted to pay for their share of the donut. How much would each quarter or piece that they had be worth? So it's a $4 donut, there's 4 pieces, it's $1 a piece. $1 from Vincent, Marcellus and Jules, plus my $1, and we've got the $4 for the donut. And if my friends Marcellus and Jules didn't arrive, and it was just Vincent and I, we've cut the donut into 2 pieces, and we had half of a donut each, what would be a fair price for my friend Vincent? The donut was $4, there's 2 of us, so it's $2 a piece. $2 for Vincent and $2 for me. Hi guys, hope you're finding this beneficial. If you are, please click the like button down below. I'd really appreciate it. Let's get back into it. So let's just rewind and backtrack for a minute and talk about how this relates to a publicly traded company. So we spoke in the last episode about a share being ownership of a company. So let's say instead of having a donut, we have a donut business. And this donut business is worth $400 million and we're going to share it. And we're going to do that by cutting it into 400 million equal pieces. So what does that mean? We've got a market capitalization or a market value of $400 million and we're cutting that into 400 million pieces. How much is each piece worth? So let's compare this back to the donut before. Rather than focus on a $400 million business and 400 million pieces, let's just focus on the numbers at the front. We've got a donut business worth $4, cut into 4 equal pieces, it's $1 a share. So now let's go and have a look at our second donut example with our donut business in mind. We've got a $400 million business. Instead of sharing it with 400 million people, we're going to share it with 200 million people. What is the price of each share? The price of each share is $2 per share. It's 400 million divided by 200 million is $2 per share, or 4 divided by 2 is $2. So what does all this mean? There are 4 key takeaways. Number 1, don't be fooled by a higher share price. A higher share price, we now know, doesn't mean that it's a better company. It doesn't mean the company is valued at more. It doesn't mean the company is going to have better returns. What we know is that this could be a result of just having less shares. If we had the $400 million donut business example and we had just 10 million shares, what would the price of a share be? It would be $40 a share. It doesn't mean the business is any better. It's just reflective of the value of the business divided by the number of shares that exist. Comparing that back to the donut itself, if you paid $2 for half of a donut or $1 for a quarter of a donut, the price of the donut is still $4. Point number 2, the share price multiplied by the outstanding number of shares is the market cap or the market capitalisation. Likewise, the value that is placed on that organisation, being the market cap, divided by the number of shares, will give you the share price. Number 3, and this is an important one. When we think about the donut and the 4 pieces that we had, 4 people here, and it was $1 for each piece, what happens if there was a 5th person that was in the room? And that 5th person wanted a piece of the donut as well, however the donut couldn't be divided by any more than the 4 pieces. That 5th person may turn around and say they're willing to pay $1.50 for a piece of that donut. That doesn't mean the value of that donut is any different. However, because of the increased demand and people paying more for that piece of the donut, the $1.50 times by the 4 pieces has now valued that donut at $6 when in fact it can be purchased, or its value is $4. The share market works exactly the same. If there are lots of people out there trying to buy and there's an increased demand for those shares, the price goes up. It doesn't necessarily mean the true value of that organisation has changed at all. In the same way that when we see a stock market crash and people start trying to sell their shares, we see that share price decline, and by default, it decreases the perceived value of that organisation. It doesn't mean that that value of that organisation has actually changed, and therefore the way the market is pricing that organisation may be well below what it's really worth. And the 4th and final point, and for me this is the most important of all, I asked the question earlier about taking a bite out of a piece of the donut compared to the whole donut and if it would taste any different. Thinking about this from a publicly listed company, does buying a share or a very small slice in a company mean that that company is any different to if you bought the entire company? No, it doesn't. It doesn't at all. And that's why it's so important that when you're buying shares, you're treating it as if you're buying that company as a whole. If that company is performing really well, the earnings are really high, there's lots of net profit, then guess what? You as a shareholder are buying into that. If, however, you're buying an organisation that has a lot of debt and is losing money, whilst you might not be responsible as a shareholder, you are absolutely buying into a business or buying a business that has lots of debt and is losing money. I think this is a really simple and powerful thought process, and one that I always try and keep in mind. When you're starting out buying shares, you might be starting out buying $500 worth of shares. So you might not treat that $500 as if you're buying a company worth $500 million. But the way in which you start out with $500 will lead into the way in which you operate when you have $5,000. When you have $5,000 to $50,000 to $500,000 to $5 million. It's so important in my view that the way you treat that $500 and that investment in buying shares in a company for $500 is the same way you would as if you were making a $5 million investment. At the end of the day, you're buying a business. The amount that you're spending in buying that organisation is almost irrelevant. The process and the due diligence you do and the reasoning and rationale behind why you buy that organisation is what's so important. That's just about all we've got time for today. Thanks so much for watching. I hope this was beneficial, and I look forward to seeing you next time.